now?
Yeah, of course I do. I do that regularly.
Okay.
So it's very familiar terminology for me. I do what you guys consider really risky. It's like I do like intraday options and I just basically flip the premiums and I trade based on technical analysis.
Okay. How's it working for you? Is it
Great,
profitable?
yeah. Yeah, profitable for sure.
Cool. What do you trade on? What
I
stocks?
trade on Thinkorswim right now with TD Ameritrade.
Yeah. No, I'm talking though. What underlings do you trade? Like
Sorry?
like Visa or a penny stock or?
Oh, I trade usually SPY options. I like looking at Tesla just because the volatility of it. If you can catch the upside or downside in Tesla, it's really profitable.
Yeah,
That's what I'm working on learning right now.
absolutely. I love Tesla for that. I'm currently a little bit upside down after yesterday, but
Oh yeah, for sure. That's yesterday was it was such an anomaly.
yeah, yeah, that and I got dumped on Facebook too.
Oh god,
Yeah, I had
must have.
like a $3 put that's now like at about $30.
Oh my god, was that a buy or sell?
No, I sold it. I sold the premium. So next week I'm going to go in and, roll it down and roll it out a month and give Facebook a chance to recover. That's the only thing to do with that thing.
What happens when you roll a contract?
So you go in and buy the old one back. So I had like $3 premium in it. And actually, I think it's about a $50 premium now. So it's going to cost me $50 to buy it back. So I'm going to take a $47 loss, and then I'm going to go out to a month out and buy the similar one, and it's going to pay me about $50 in premium. So I'll end up with like a $3 profit. I just have to wait a month.
Hmm. So what's the actions that are taken after you roll it? You roll it. That means you get rid of the contract that you're currently in.
Yeah, I will buy the old contract back. So then I'm completely out of the trade. I could walk away right there with a loss and be done.
Mm-hmm.
And then I go out and I sell like a 30-day contract to get my premium back. So I come back to even.
Ah, I see. And
So
that's just because the value of your
it's just two
contract.
transactions. It's two transactions, and we just call it rolling it.
And in every situation, rolling a contract would net you that $3.
It will net you something positive.
Okay. Is
So
that something you do often to profit?
that's what you do to save your ass
You buy back your contract and you and then
and to sell it again.
sell another one.
The market pays you to wait because the options are built with profit in there for this option seller, and you get that time premium. And so I'll just put it out there for a month, and Time Decay will start working on that contract, and I end up in the green.
Ah, this works on your side, right? Time decay works on your side.
Absolutely.
That is so weird. That is a foreign concept to me. Usually, time decay is kicking my butt during the day.
No, you want to be selling premium long term, and just let it work for you. It's it's beautiful.
It seems really more like safe. Like honestly, usually, if I see traders that trade intraday options like me, based on technical analysis, sure it's profitable. But if you're going into trades and you don't know where you want to enter and exit, which I see numerous amounts of people who are new to options do, it's just crazy because you lose like 90% of your portfolio in a play if you don't know how to handle your risk.
Sure. Yeah. Yeah. A lot of people don't believe how simple this is and how safe it is. Like, well, yesterday My portfolio is down $7,000, but I have absolutely no worries with it because all I'm going to do is roll these big snafus out for a month, and it's all going to decay right back into my portfolio.
That's gonna net you over $7,000, and
Yeah, I was on the negative side yesterday for that because I was on the upside down of Facebook and Tesla and Amazon. But my account's pretty good size, so I swing $5,000 to $7,000 a day almost every day.
I see.
But over the long term, I'm up 15% this year, and just this last month, I think I'm up at like $12,000 for the month.
Wow, and that's just from capital gains as well as
It's just
the
premium.
options gains.
Premium. It's all premium.
All premiums. Wow. 12,000 all premiums. That's great.
Yeah. That's why I'm trying to share. That's why I'm trying to share this. It's beautiful. And it worked. It worked through the pandemic, so it'll work in about as bad a situation.
Oh, I'm sure options traders are profitable in all market conditions.
Yeah.
As long as you play the right hand.
Yeah.
Where should I start to actually? I think my problem right now is I'm not really piecing together what selling an option is and how it works, I guess.
Say that again.
I think my current question would just be how it actually works, how it all would play out on a day maybe. So say I'm trading Cisco stock sitting at $45. What would prompt me to sell a put, sell a call, or sell a call?
Well, you'd only want to sell a call if you owned the stock.
Okay, so if you're playing with cash secured, or if you're playing just cash secured, you'd only want to sell puts, not sell calls.
Right. So if I can't really help you on day trading because there's not on day trading you really don't have any time decay. You're just timing the market. So let me do this. Let's see if I can share the screen. Oh, it's not logged in. Let me log in real quick now. Oh no, I didn't want to do that. Thanks for swimming. Okay, so you say you're looking at Cisco?
Yeah, Cisco.
So okay, you seeing my Thinkorswim screen here?
Yep, all clear.
What's the symbol ticker for Cisco? CSCO. CSCO? That's not one I trade, so. Okay.
Do you trade everything in your watch list?
No.
No? Okay.
Not at all. So I would look at Cisco and I would look at a 1 year, 1 day, and I would see that it looks like it's got resistance about here and it's got some support about here. And I look at over here and see that currently at 44. So I'd go out to trade and I'd look at, well, this would be next week, Friday expiration. And I look at probability of out of the money, and I'd come down to around 68%. And so I would go out here and look and sell a strap at 45 for about 40 cents.
And you always look for around 60-ish%?
Around 68.
68, okay.
And the reason I use 68 is it's on a mathematical formula on, I forget what it is. It's where 95% of your trades will fall into that percentage. So you have about a 68% chance of winning this trade and it'll close in 7 days.
And you
Or 5
always
days.
do, normally, you always do options with a week expiration?
I used to do about 2 or 3 weeks, but the markets are so choppy now
Right.
that I've pulled it in.
Really.
But I like to at least have a weekend in there because time decays your friend, and I like it to decay over the weekend.
So this is a week contract. So if you bought it on Monday, you wouldn't have that time decay, right? So you'd probably want to look at July 10th maybe if you were if I was playing a little bit longer per se.
Sure. So let's look at July 13th and a 68% in there. But gets you, about a 60% premium. And you can always buy it back at any time. Like, you trade, intraday trade them. You can, if they start going against you, or if the stock moves, if the stock moves up, this is going to fall, and you can just buy it back then. It's certainly not as exciting as day trading them, but it's a little bit more consistent.
Right, that's 100% what I'm looking for, just that consistency.
Yeah. Let's see. Yep. Yep, it'll give it to you there.
So what would prompt me to sell the call at that 44.5 strike price?
That's the $1 million question. You mean the put? You said call.
Oh, yeah. Sorry. Yeah.
Yeah. You do your technical analysis, and you just, it's a call on what you think the stock's going to do. I like 68 is just a starting point. If you want to be a little bit safer and not get it assigned to you, sure, drop to the 44. Then you get a 73% chance of winning. And if you want an 87% chance, do the 41, but you're only getting probably 20-cent premium. The better premium is a little bit higher risk. If you actually want to buy the stock, and you don't mind buying the stock, go right close to in the money. When it's 46, so sell at 46.50. So it's going to pay you $1.70, maybe say $1.70. And if you don't mind owning it, then your actual entry price into the stock is going to be like $46.30 minus $1.70. So you're buying it at 45 something.
So to reiterate that, let's go with the at-the-money option. So currently the stock price is $46.31.
Uh-huh.
if I were to buy the 4650 strike,
You're gonna
or sell it.
you're
Sorry,
gonna
if I
sell
were
it.
to sell the 4630 strike, 4650 strike at 174, and somebody buys I will get it assigned, right? Because somebody's gonna buy it since it's at the money.
Yeah, most likely at 46.50. Well, it just depends on where the stock is on the expiration date. If it's above that strike price, you will get assigned. No, I'm sorry, take that back. If it's below that strike price, you'll get assigned. So
Okay, so it just drops like 46.
say you sell the 46.50 strike, and on expiration Friday the stock is trading at 45.
Mm-hmm.
You're going to get assigned that stock at 46.50 because that's the strike price. So you'll be $1.50 in the hole, but your premium will cover it at $1.74. But you will own the stock at 46.50.
Well, that wouldn't really make up for the loss, right? Since I'm a dollar multiplied by 100 down the hole.
Yeah, you kind of broke up, but yeah. So go ahead.
What I was saying was like that wouldn't really cover my losses, right? Since the stock price would be like 45, and I'd be $1.50 down the hole, right?
Well, you'd be about 25 cents a share ahead.
25 cents a share.
Yeah. So, because you're gonna
premium multiplied by 100 as well. Sorry.
Yeah. Yeah, we're talking about. So everything's times 100. So it'd be $25. Because you're getting paid $1.74 to take the risk. Now you wouldn't want to do this on a stock that you thought was going down. You'd want to do it on a stock you think's going up or staying even. So if you sold the 46.50, your best possible outcome just to collect premium would have the stock close above 46.50. You keep the premium and you don't have to buy any stock.
Well, if you sell the put at 174, right, at that 46.50 strike, your goal to profit ultimately is the stock price goes up and you don't get assigned and you profit off the premium.
Correct.
After selling it come expiration.
Correct.
How would your premium increase since you're selling puts if the stock price goes up?
The premium does not increase after you trade. Your premium is whatever you traded it at.
Yeah, but how does the value of the premium increase?
Well, on a put, the value will go up when the stock goes down.
Right. But I guess my question is, if you the trader is wanting the stock price to move upwards, so you don't get assigned, how would you profit if you're selling a put?
Okay, when you sell the put, if you sell this 46.50 for $1.74, that would be your premium. So you'd make $174, and it doesn't go up. It's just whatever you sold it for. Now, if
it's clicking. Okay.
Now, if the stock price is above 46.50 on expiration, you don't have to buy any stock. You just walk away and you're done. And you can turn around and sell the next put.
So I'm basically getting paid $174 for nothing.
You're getting paid that what you're doing, you're selling insurance. So someone's afraid it's going to fall, and they'll pay you for it. So that if the price, let's see, did I say that right? It's too early for me. So yeah, you're wanting the price to stay above 47. So what you're doing is ensuring to someone else that it does not fall below that price. Because if it falls, say the stock falls to 45, your strike price is going to trigger, and you're going to buy it out of the market for 46.50. So they're getting a guarantee that they get at least 46.50 for their shares, and you're getting paid that premium to provide that insurance to them.
Oh, that makes perfect sense, actually.
Yeah, once you wrap your head around it, that's what you're doing. You're selling insurance.
Okay, yeah.
And insurance.
Yeah. Okay, so I'm getting it. Yeah.
And insurance is expensive. That's why I like to sell it and not buy it.
Right. Okay. So this is wow. Why don't people do this? This is like significant upside. Okay. Okay.
Yeah. Once it clicks with you, it's like, oh my goodness.
Okay. Yeah. So if I'm selling that 46.50 at 174, and it's just gonna sit there until somebody buys it, right?
Well, yeah. You just have to monitor your stock and see if the stock has gone low. So if the stock has gone down to 45, you're going to get assigned. So you may want to roll it out to the next month at a lower price and get paid again. Because say it gets there, and you're looking at and it's going to get assigned to you. So it's at 140 now, and let's look at the next one out at what's that? 46.50 is 174. Let's go to the next. Let's give it. Say we want to roll it up 2 weeks. 46.50 is now going to pay you $5. So if you get in trouble, you roll it out again and you make more money. You can't screw it up.
And that's just like an automatic fight. Like you don't lose out on that.
You buy the old one back at $1.50 or about whatever you paid for it, and you sell the new one. It will always work in your favor because what you're doing, you're selling time. This one's further out in time, so it's worth more. The very same strike price is worth more further out in time. You just have to wait for your money. Well, you get the money immediately, but you're just obligated to that share for another 2 weeks, to that contract.
I see. And then after this one, it's the time of expiration for the one you rolled out, what would happen from there?
Well, the first one, you bought it back, so you're relieved from that contract.
Mm-hmm.
So the new one, now this one has 27 days. So you can what generally happens in that 27 days is your stock will go up, this will fall, you buy it back, take your profit, and walk away. Because
I see. God, it's okay.
Yeah, if the stock goes up, this price is going to fall, and you can buy your option back on the cheap.
Okay, so at that point, so from start to finish, if you're buying a weekly option, so seven days out, and you're buying it at let's say 46.50 for 174, and if at the time of your option's expiration, the stock price is trading under 46.50,
right,
you can save your ass by rolling it to July 24th, 27 days out,
Absolutely.
and you wait for it to
To go
you wait for the
profitable.
stock price to go up,
Yep.
and then you wait to buy your premium back at lower than 174.
Well, no, you've already bought that one back, so don't worry about that one. So now you're just looking to get a buyback under $5 because you just sold this one for $5.
You sell that one for $5?
Yeah, when you sell the new put, this one will be
Mm-hmm.
selling at $5. So now you only have to get, this price under $5 because the other one washed out. You already broke even on the other one. Actually, in this instance, you're a $3 ahead. So, yeah, I mean, just do the math. It's
Sorry to just interrupt here. I'm just going to say thank you for the Zoom meeting, and I'm going to head off now.
okay. Well, I appreciate you coming by. And you can check back next
I'll
week
come.
too if you want.
Of course, I'll come back next time. So
Okay.
good luck. Thank you.
Bye. So yeah, this is why I like to sell premium.
Yeah, so I think I'm gonna like it too.
It works really well. It really does.
I think it's just once I literally gotta just wrap my head around it because I'll be playing both sides of the game. It's just really weird.
Well, you can still play both sides, just do it one at a time. So, if you're not day trading, if it's actually a stock you want to hold, just go ahead and go real close to at the money and let it get assigned to you and then start selling covered calls on it. The trick is don't get involved in a company that's like PCG or whatever it is that's, going bankrupt. You don't want to mess with those. That can leave you
Mm-hmm.
in a mess. But, stick with the nice companies. So what you thinking? Just gotta let it sink in.
Huh?
You just gotta let it sink in.
Yeah, I'm still trying to wrap my head around the whole wash sale concept.
Okay, so let's go back to the 13th. So let's say you got a premium of $1, or let's say $46.50. You got a premium of $1.74. So what's going to happen if the stock goes against you? This premium is going to go up. Say it goes up to $3.25. Okay, so you got premium at $1.40, but it's going to cost you $3.25 to buy it back. But you want to buy it back because you don't want to get assigned, right? So you pay $3.25. Now you go out your 2 weeks, and you're $46.50. Now you can sell this for $5. So your $5 covers your $3.25 that you had to buy your old one back. So now you're ahead of $1.75. So once this decays to 175 or less, then you can exit the contract even.
But just buying that one back, right?
Right. You buy it back for $1.75.
Wow. I'm getting it.
Yeah.
All right. That's great. Okay. Okay.
And you only have to do this if your position goes against you.
Mm-hmm.
This is just a way to make sure that no trade costs you money.
Right. Okay.
And when you get that under your belt, then it all becomes gravy because everything's a winner.
Yeah, I think I just need to go ahead and learn some more. Probably. Yeah, this I got the I guess this would be called the beginner concept. I think I got it now.
Cool.
What would be next in terms of learning? I guess.
Doing it and repeating it. This is
Right.
this is as complex as I go.
Okay.
This is my whole
Well,
system.
just trying to profit off that premium and rolling it if it goes against you, huh?
Yeah. Yeah, if you don't have losers, then you don't have to have big winners. Though winners just keep adding up.
Right, right. Could we maybe do another example on stock ticker T?
T?
Yeah.
Sure. Okay, so let's look. Say we want to do a 13 days out, and we're at 29 bids. So I would come over here and look at 68%. So let's go 65%. Sell the 28 strat at about 50 cents.
Okay, just in the middle of bid and ask.
Yeah, I'm just guessing, between the bid and ask. You try to get your best, something in the spread. So say it goes against you. So you're in it for a strike at 28, but it dropped to 26. And say that it's going to cost you $1 to buy it back.
Okay.
So let's go out and let's look 30 days out. And so you look at what you can get $1 for. So you can get, you can sell a strike at 28.50, which is about where you're at now, or a little less. You get your $1.10 back, so you're back to even, but you got 27 days to let T come up.
I didn't really get that part when you rolled it to the July 24th. Could you reverse it or back up to the
Okay, so
yeah.
so say you sold the 28, and you got 55-cent premium, right?
Yeah, so you pocket 50 bucks.
55 cents, yeah. So, but now come expiration day, it's trading at 26. So you're going to get assigned at 28, right? You don't want to take the stock, but at that time, to buy it back, it's gone up because it's gone down because the price of the stock's gone down. So it might cost you $1 to buy it back. So you're 45 cents negative, right? So you're at negative 45. So what you need to do, go to the 27th and go back to 28. They're going to pay you about 80 cents for a put to the 28th. So you're gonna cover your loss of 45 plus get 45. So you get another $45 to wait for 27 days.
Can I repeat it back to you and you maybe tell me if I'm understanding it correctly?
Sure. I'll come back here.
All right, so I'm selling the 28 strike price for, let's say, 50 cents. Okay. Nearing the expiration date, the stock goes down to 26, so the premium is at $1.
All right.
I pay $1, so I'm negative 50 cents to roll the contract over to the July 24th.
Right.
And I choose a higher strike this time, maybe 28.5, sure, for $1. Let's say $1.10, just to make it easy. So at that point, I would I'm at down 50 cents. If I'm selling this contract, I'd be up 60 cents.
Correct.
And I would just have to wait until expiration and the stock price is higher than 28.50 to be able to to claim that 60 cents, so $60.
Now you get the $60 immediately.
Okay, okay.
So yeah, then you're just, you know, your old trade's done, and so you're just watching this one. So you let time decay start working on it, and when this gets below 110, then you can exit the trade immediately with a profit for, and not be under any more obligation.
Wow. So at that point, I already pocketed 60 cents. I'm just in the trade, right?
Yeah.
Okay. I'm just in the trade waiting for the stock price to rise up so the premium would go lower, right? For buyers.
Exactly.
And then when would I profit? When I buy back my sold put?
Now you get the cash into your account when you do the sell. What you do when you buy it back is you just relieve the obligation. So you'll actually have to pay to buy it back. So you'll lose a little cash out of your account, but the contract is then goes away.
So relieving your position is different than just buying it back and getting out of the trade, right?
Yeah, well, no, it's the same thing. It's just so when you buy your put back, you're no longer obligated to buy shares anymore. So that's just exiting the contract. It's sell to close. No, it's buy to close. So you sell the contract to open it up, and then you buy it to close it. And then you're just even Stevens again.
Okay, I probably need to get some more experience on this. I'll hop in the what's it called, the
Discord.
TD Ameritrade.
Oh, okay.
It's like the day replayer or whatever. I'm probably gonna need to do some
Yeah.
trial in there.
Yeah, it's mind bending until you get your head around it. But then when it clicks, it's just all good.
Yeah, I think I'm good at the first part though. Just how you would profit and what would happen if the trade went against you. I think I just need to see it happen during the trading day to be able to like actually comprehend what I'm doing.
Yeah, well, or you profit is when the stock is below your strike price and you get to expiration. That's where you truly profit.
Below the strike price or above?
Yeah, above. I'm sorry.
Okay. That's where you earn your profit. Okay, yeah, that does make sense to me. I think this is a matter of seeing it in action. Did you go over anything else with Allgood and Osmith before I came? I know I came late.
Yeah, Allgood's. We were just waiting for because he was going to be on a short time frame, but we went over. I don't even remember now. I'd have to review the video.
Okay.
I've got a short memory.
No problem. I'll take a look at that later.
Okay. Well, if you haven't got anything else today, I think Allgood's been patiently waiting, so.
Yeah, yes, no, I'm learning. I learned a lot while Harrison was questioning you. It just made sense because I'm in that position right now, and that is what I wanted to discuss with you. And all right, if we go to, I bought Cisco, the other one SYY ticker symbol on the, let's see, where was I? Yeah, on the for July the 2nd. Okay, I'm confused here, Randy. July 2nd is Thursday. Friday is because Friday will be closed for the Independence Day, right? Is that the reason?
Yeah, I think July 2nd, I think, I don't know what day that is. Let's see.
Yeah, it's next Friday. I believe it's markets closed for Independence Day.
Yeah, actually the 2nd is on a Thursday, so that's the last trading day.
Right. So that was kind of throwing me off, and I said, "Oh, okay. It must be this. What must be the reason? Because always it closes. The expiration date is always on a Friday." So, anyways, I bought Cisco, and on I bought it yesterday. Yes. And what happened was that it is going against me. It was like 51.50 put for 81 cents, and now it's where is it? July.
$1.55.
Yeah.
Okay.
I'm in,
And so I'm
yeah, so
assuming
it,
you don't want to buy Cisco?
okay, July 2nd. So now if you see 51.50, it's like 50 or 56% probability of being, assigned to me.
Uh-huh.
And it's gone up. So the same rule applies as you're telling Harrison that I have to buy it back, but I would be losing money on it because now I'd be paying, I don't know, something between 95 and $1.55, where the premium I got was $81. So then what I do is like you were teaching him, I roll it out because I'm losing here. Because I really want the premium, I don't want the stock assigned
Okay.
to me. So that's a sweet deal. I mean, I did not know. This is what I learned. Like you were teaching Harrison that I can go further 2 weeks and then buy it back, and this I will sell, but I will lose money on it. But when I turn around 2 weeks, roll it out 2 weeks further out, it will be, let's see, what will it be then? What that time? It will
Yeah,
be,
so right here you'll buy it back for $1.55, and then
Yeah.
you'll come out 2 weeks. And what was the strike price?
51.50.
$51.50. You can
Yes.
sell the new one for about $2.70. So they're going to pay you to wait.
So which one are we looking at? July 17th?
Yeah, that's what I went 2 weeks.
Oh, okay.
So the premium on it for 2 weeks out is about $2.70. So that'll cover your $1.55 that you have to buy it back. Now what you can do if it's going against you, since you only have $1.55 in it, you can look here and come into a 50 and still get $1.70 and lower your strike price by $2.50.
Yeah.
So you can keep working it into your favor.
Right. So are you saying what? Go to 50, so $1.80, between $1.80 and $2.20 is again getting less, but then
But you're bringing your strike price down, so you're bringing your risk down. So you were obligated at $52.50. Now you dropped it $2.50 on your strike price, and you still got enough to cover your old position that's gone bad.
Awesome. That's awesome.
And that's how it works.
So I'm not stuck with 51.50. I can pick up any strike price just to
Absolutely,
cover
any
my
price
loss,
you
right?
want. Any price you want. Whatever makes sense.
All right. Oh my gosh, that is awesome. It's fascinating. Yeah, thank you. So, all right. So now my next question is, when I'm selling it, I forgot because this is my second time selling a put. When I go in, I go buy to close is my the trade I'm making, but I'm going to the put side, right? I'm not doing. I have nothing to do with the calls, right? It's just the
Correct.
put I'm making.
You're all on the put side.
You're on the put side, so we stay on the put side.
Yeah.
Oh, awesome. Wow. Right. So
Yep.
what happens if again my market drops it, but that's 2 weeks out. We don't know what's going to happen, right? So I keep doing it, right?
You do it until you're
Something.
profitable. You can do it for 6 months at a time if you want. Just over and over and over. Just till never take a loss. Never take a loss.
You're awesome. I wish more people could, learn from you. Because it's so easy. The way you explained it, and like to Harrison, I was watching. I mean, I was listening, and I was getting it straight in my mind, and it made sense. The only thing that didn't make sense to me, if Harrison is there, yeah, he's there. Why he wanted a put in the money put? Why he wanted to sell in the money higher than the thing? That's my question. on Cisco, your Cisco, Harrison?
I forgot which. I don't know. Forgot which strike price we were looking at.
But your strike price was in the money. It was not out of the money. See, so I was kind of confused. I want to learn why you want to sell a put in the money, which is higher than the your stock price. Usually you go low.
Yeah, usually I don't think I remember doing that, but if I guess to explain it, if I were to roll over that contract I'm losing from, right? And let's say I roll it out 2 weeks out, I guess my impression would be if I'm going to sell a in the money contract, it would be I'm selling it with the impression that the stock price would be going higher than what it is right now.
Oh, I got you.
Yeah, but
Yeah, that's a very bullish strategy. It gets you more
Yeah.
premium.
I think
But
I would
then-
just go safer and just try to profit off of just a little bit more than the contract I lost with. So like maybe like if I'm rolling over, if I sold a contract at 50 cents and it reversed on me and now it's worth $1 and I'm down 50 cents, I would
Yes.
probably find a reasonable strike price a reasonable contract a couple weeks out where I make that dollar back and a little bit more. So maybe if I'm looking at your Cisco, I'd look at that 48 call or 48 put, which is worth around $1.15 to $1.60. That way I just cover my $1 loss and profit whatever is there.
So
And
you would
plus,
go out of the money, way out as low as you can.
Yeah, that's what Randy explained to me, and that just made more sense because you're
Right.
covering all your risk basically with
Right.
little
That's
to
why-
no additional risk. Yeah.
Right, that's why I was confused because you're selling in the money, one step up in the money, and that's what I was confused. That usually you go out of the money below about 68%. That's what Randy taught me. 68 or below. So I got it.
okay, guys, I think that's about our hour for this week. So
Yes. Thank you so much.
I gotta go start.
I learned a lot.
I gotta go
Yes,
start
I
getting
did.
ready for
I
some
did.
company.
Yep. Before I let you go, one more question. So
Sure.
now, if I put the trade on, it would be Monday, right? Can I already do it? Like leave it as a limit of this thing, or do market? I usually do market.
I wouldn't. I would wait until a trading day, and you may actually want to follow it because we may get a bounce on Monday.
Yes, that's
It
right.
may come profitable, 'cause-
I shouldn't be in a hurry. Great, awesome, thank you. We have just kind of picked your brain into well, you need to get some nourishment and coffee or whatever, and you have a great Saturday. And I'll see you in the evening, Randy, if you care to, because my chit chat will be on from 8, our time. If you want to pop in, if not, that's fine.
Yeah, I'll try. I'll try at least for a little bit.
Sure.
It's just
Just
I get up pretty early, so that starts getting
Yes.
pretty late for me. So
Sure, that's fine because Dave is always up to something. It's a fun this thing, a very fun a kind of a meeting. So it's up to you. I just wanted to remind you, and I don't want to send you a reminder. Now you know that tonight we'll be on again.
yeah, I'm getting involved in so many streams. My wife's starting to think that I don't live here anymore. So
I know. Poor wives, they're all kind of not very very happy. Husbands, some women, their husbands are not happy. So,
okay.
anyways, we'll let you go. You have a good weekend, and thank you so much, Randy.
Thanks you too, and y'all. Thanks for showing up. I'm gonna kick the meeting out now. So
All right.
Thank you. I definitely learned a lot. I'll look forward to learning more from you in the
yeah,
future.
we do this
Yeah.
again on Thursday at 8 p.m. if you want to drop by for that one too.
Definitely.
Okay, see y'all. Thanks.
See you. Thank you.